The stock market has lost its mind again. Why is the stock market going parabolic? Well, if you guys joined the live streams, we covered CPI, we covered FOMC. You kind of have an idea, but I'm going to dive deeper into Jerome Powell's comments first of all and tell you why the stock market went parabolic right after CPI and then followed up by FOMC. Also, what is expected from the stock market? How much more left do we have? How much more juice do we have left in the stock market, being that we are very close to all-time highs, something that I predicted back in September of this year, which I showed you, but we're about 2% away from all-time highs on the S&P, and we are about less than 1% away from all-time highs on QQQ. So where is the stock market going? What else am I looking at? I do think the stock market obviously looks like it is extended. I don't want to use the word overbought, so I won't use the word overbought, but it looks obviously extended. It looks like, you know, a pullback, a small pullback would be healthy. But are there opportunities left to squeeze in this market? What else can we squeeze out of the market? You guys know that I have my eye on bonds. I had my eye on gold. We had that $11,000 per contract trade on gold. That was all based on interest rates and the dollar, right? So it's not merely just looking sometimes at the singular instrument. You want to look at the whole macro picture. So I do think there are some monster trades. We've already taken some pretty monster trades in preparation for this, so I will go over that as well. But I want to give you guys more context why the stock market is going parabolic and what we can expect from here. Also, I want to say make sure you are following me on X and on Instagram for a couple of reasons. I did a whole write-up on X how we found the bottom of the stock market, how it is that we found the bottom in IWM. I included my whole IWM write-up, which is the Russell 2000 from November 10th. I included my whole bond write-up from November 8th, as you can see here, the date up here. I included my whole S&P 500 write-up from October 25th. These were the dates that we started entering these things, the SPY, the Russell 2000, as well as bonds. Currently up almost 500% on Unity. I actually gave this actual call out on Instagram, right? Every week I do these sort of top things that I'm watching. I do a reel showing you the top things that I'm watching, and Unity was one of the things on there, as well as the QQQ getting to 400, which that obviously happened as well. Now, before we jump into the video, I want to address something. Sometimes a few of you that aren't familiar with our work, that are not familiar with the Discord, that are not in the Discord, you really, are curious to know whether these positions are actually posted, and they are all posted here for you, right? And the other thing is you want to know how, whether the win rate is as high as portrayed. Everything is posted here, right? Including the positions that we took a loss on. Now, out of everything I traded this month, I've had 2 losses. I took 1 loss on an RTY short for 3.3 points, which is 165 per contract. And a couple days after that, I took a loss on a Tesla put position. That was it in terms of my losses for December so far. But we are up 38% on TMF. This is a bond ETF, 17% on the IWM. As I said, we caught almost the bottom of the Russell 2000. On Celsius calls, we were up 112%, closed those as well. By now, you guys know my very public SPY position at 410, which is almost the exact bottom of the SPY, up 14.5% on the S&P 500. All that is to say, we set ourselves up for this moment. Not that I knew that all of those things were the exact bottom, but because of the convergence of economic indicators and economic data, right, between interest rates, inflation, the dollar, stocks, and bonds, I bought into these things around the same time based on the same economic factors, and I didn't care whether that was the bottom or not. It just happened to be the bottom. I knew that it was an optimal time to buy, and you get rewarded for it when the market starts rallying. All that is to say, guys, I have nothing to hide. If you want to take a peek at all this stuff, I will let you go through here and look at all of the recent alerts. If you want to take a peek at this, use the coupon code below and you can join the server for 5 days for free. And you could take a look, poke around yourself, take a look at how we do the call outs, take a look at the chat, take a look at the recent alerts, take a look at the recent wins, as well as the couple of losses that we had. Take a look at all that stuff. Like, feel free to come come by and take a peek. I would love to have you. I would welcome you, and let's get right into the video. Okay, so the reason that the market continued rallying, CPI came in line. And what did I tell you guys? I said that CPI is set up to either meet or beat. I do not see the CPI coming in higher than expected. CPI was expected at 3.1. It came in at 3.1 year over year. And I did not expect CPI to come in higher. Now, I said that there would be a crazy, crazy scenario if it came in at 2.999 something. And, you know, I didn't give any sort of confidence in terms of the chances of that happening. But I said if that happens, the market is going to go even more parabolic than it went. But at minimum, I expect CPI to at least meet, meaning we are going to meet expectations, which is going to be bullish in the short term. Then we had FOMC. What did I say for FOMC? I said that the Fed is done hiking. July was the last hike ever for this rate hiking cycle, and that we would not see a rate hike come in December. And guess what? We did not see a rate hike in December. The Fed kept the rates unchanged. And as you see here, the highest probability for January is unchanged. The highest probability for March is actually a rate cut. And this is what we're going to be talking about. So it was already priced in that the Fed would not hike. So why did the market continue to soar if that was priced in? Well, it's because of what our main man, Jerome Powell, had to say. Take a look at this. This is the first time that Jerome Powell actually said this.
And we are strongly committed to returning inflation to our 2% objective. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured.
So he said for the first time ever that rates are likely at or near the peak. Now, why is that important? Because as I said before, the last rate hike and when the Fed announces that this is the last rate hike are very two different things. So just like in 2006, which to me is the closest rate hiking cycle that we have recently to what we're doing now, even though now was a lot faster than 2006, right? We ended up at 5.25% in 2006, but it took 2 years to get there. Here, it took us less than 2 years to get to 5.25%. And we were starting from basically zero, not from 1.25% like we did in 2004. But the last rate hike was June 2006. The Fed didn't really announce that it was the last rate hike until 2007. And then by December 2007, we were already in a recession. So in this case, when the Fed actually says, when the last rate hike was in July, right? July 26, 2023, we are now in December. And so the whole time the Fed is just stringing us along saying, you know, we don't know if we're going to hike. We don't know if we're at the peak. We don't know. We haven't discussed the last Fed meeting minutes. They said we haven't discussed rate cuts at all. And now he's saying not only that we are near the end of the rate hiking cycle, but let's take a look at the dot plot. The Fed was basically lying when they said they have not discussed rate cuts at all. If you look here, you could see, that at least 5 members, 1, 2, 3, 4, and then 5 down here, are projecting not only rate cuts, but at least 100 basis points of rate cuts, which is insane. That was not priced in before. Most of the Fed members were at somewhere between 1/2 to 3/4. And now at least 5 members are projecting a 100 basis point rate cut for 2024, right? Along with Jerome Powell saying that we are near the peak. So not only did stocks rally, but because I expected and because my estimation was that July was the last rate hike, we got a rally in bonds, we got a tanking in the dollar, and we also got a rally in gold, right? All happening at the same time because of what Jerome Powell's comments said and because of what the dot plot showed. And even on my Instagram, I said on my top stocks that I was watching that week, gold was in there. I said the dollar's at resistance and gold is at the weekly fair value gap. If CPI comes in line or better and yields drop, so will the dollar, spiking the next rally in gold. And you can see here, you could probably see it better on GLD. A lot of you don't trade futures, although I don't know why, but it was right here. I released the reel on basically this red candle, and then this was FOMC day, and we had this humongous rally in gold. And if you take a look at the dollar, you also had a massive drop in the dollar because the dollar and gold are inverse. So I've been with you every step of the way, not only calling this rally, but trying to keep you informed on what I think the Fed is going to do and what the reactions we will get from commodities, as well as from interest rates, as well as from the equities and the bond markets as well, because they are all interplayed. Now, where do I think the stock market is going? Here actually is the hard part, okay? I mean, you thought that, predicting the bottom or predicting that we would rally violently. Actually, I have a tweet here that's from October 26th, marked to the basically the candle before the bottom, saying the one thing I can guarantee you about the stock market crash is that most retail will not buy. When the market rips, it'll be fast, violent, and surprising, just like it always is. And if you look back at my videos where I was saying all-time highs before the end of the year, I was called a clown. I was called crazy. People were laughing. Obviously, most of those comments are deleted now, but most people were cool and most people are nice. So I don't want to give a sense that that was everybody. But this is actually the hard part here. The hard part is trying to find where the next level of resistance will be when we don't have a level of resistance. We don't have any data beyond all-time highs, right? So like I said, we are very close to all-time highs. And if you pull a volume profile and you look, there is very little volume here, right? So you are hoping that now this turns into a level that is accepted, and that money managers start pouring money in even more than they have. As I said, part of this rally was a short squeeze, and another part of this rally was a repositioning rally where a lot of money managers were on the sideline. And I took a look at the money managers' data as part of my thesis for calling this the bottom or near the bottom, right? Is because money managers were underinvested. And I thought that if we got any sort of good news towards the end of the year, money managers would rush to make money for their clients because they've been sitting on the sidelines the whole time or sitting in bonds the whole time, right? So they would rush to make a real return. And they definitely did. The stock market made a rally that is worthy of an entire year of investing, but it did that, within a month and a half. So you don't have a ton of volume here, and you need volume to be picked up in order for this level to be established and considered the new normal. And that is historically how highs are always broken, right? They always seem outrageous at the time, and then once they are accepted, then we tend to surpass that. Now, what I think will happen is this. I personally think we will see a recession, right? I don't think that a recession is averted. I know that we have a lot of euphoria from this week, from what the Fed was signaling, etc. But I do think we will have a recession because this is how it always is. I'm old enough to remember the soft landing conversations before 2008, before the dot-com bubble, right? The soft landing conversations are always the same. Like what Fed president or Fed member or economist is working for the government or for a body that is closely tied to the government, because the Fed technically is not part of the government. But what person in that position is going to say, actually, guys, we're not gonna do our jobs we properly, and we risk a very hard landing? Nobody's going to say that, right? The job is meant to project optimism and encouragement, right? So you're never going to get an honest take from the Fed or the Treasury or whatever. So this is how it always is, and I have no reason to believe otherwise. But what can happen is similar to what happened in 2018, where we surpassed all-time highs in 2018. And there was some rate-related discomfort here. There was some talks of a recession here. Obviously, the recession ended up happening a little bit later, a couple years later. But we did surpass all-time highs, and then we eventually had a taper tantrum, and we eventually fell in 2018 almost to a bear market. This was a severe correction that lasted 19%, not quite to 20%, right? So I do think something like that can happen where we will surpass all-time highs. For me, there isn't really a reason for the market to crash severely from here. Small pullbacks here and there, sure. There isn't really a reason for the market to crash here, unless we get obviously some sort of black swan event or some sort of credit event. But I think the Fed will have to hold the rates higher for longer before that happens. Unemployment is going to tick up because obviously that is what they look for. The Fed also said as much in FOMC that they project unemployment at 4.1%. It's currently at 3.7%. So unemployment is being very stubborn, but it will eventually cross that 4 threshold. This bond yield curve between the 10 and the 2 will eventually uninvert, right? But it could be so long before that happens. This was my point, guys, that you cannot hang your hat on a bearish scenario that can play out in a year to 3 years, right? Or sorry, a year to 2 years. You cannot hang your hat on that because in 2 years, just like we saw in 2007, the stock market can rally insanely and you miss almost a lifetime of gains, honestly. And then when it finally retraces, it's not going to retrace to the levels that you know, right? These are the levels that we know now. But how do you know that the stock market won't be so high up that the level you retrace to is already a level that surpasses these highs? So I think it'll be similar to 2018. No two conditions are exactly the same, where we will surpass all-time highs, and then it's just going to be a game of chicken between unemployment, between the Fed rates, between the wage growth, which is already coming down, and between uninverted yield curves, right? It's going to basically be a game of chicken. Which one of these things is going to unwind before, are all of these things going to take shape the way that they're planned to without the economy crashing? Because when unemployment starts ticking up, right, what happens? People start defaulting, right? When the yield curve starts uninverting, it is usually because there is pressure on the financial conditions. If people start defaulting, you get the short-term yield starting to come down as this uninverts. Well, it's the rate at which people are defaulting and what they're defaulting on, right? We don't know all of the credit risks, and we don't know all of the hidden credit bubbles that exist, whether it's in housing, whether it's in consumer credit, whether it's in commercial real estate, whether it's in commercial credit. We don't know. These things are very hard to uncover because every aspect of our financial society is over leveraged with credit. So we don't know what is the thing that's going to break. But when we get to that point, it could be a year from now. It could be 2 years from now. Right now, the Fed is actually projecting a recession much earlier, which is why we saw that dot plot showing 100 basis points from 5 of the members. And also, we have the Fed funds futures. This means that economists as well as Fed members are actually predicting a recession very soon because they're not going to cut prematurely. The Fed only cuts when we are either near a recession or in a recession or something starts to unwind. We have data for this, just like they started doing in 2006. In 2006, was the last rate hike. The Fed didn't start cutting until September 18, 2007, and by that time it was already too late, right? It's like, when you get in the shower and the water is cold and you turn the knob all the way hot and you finally find a temperature that you like and you step in the shower, but you've turned the knob so hot that there's a lag effect between the temperature of the water and how high you turn the knob. That's how it is. These are blunt instruments, right? So it's going to take a while in my view, for at least, a year, maybe shorter, but for these things to unfold. And until then, the market can continue higher and accept this high. And then it's just a matter of what is going to start cracking under pressure that will cause the Fed to cut. And at that point, you'll see yields absolutely tank. You're going to see bonds absolutely rally even more than they have. If you look at this, even on a weekly, you could see that the rally that bonds have had, this is TLT, is really just a blip. We are up 11% on TLT, by the way, but it's really just a blip. The real rally in TLT, in TMF, in SHY, in ZT futures, the real rally will occur when the Fed actually cuts, right? And they're not going to cut until something happens. So, you know, I think that if you're looking for an answer on whether you should buy this market, in my view, I think you're too late. I think the market will only give you so many chances to enter. And I think right now it's too late and you have to wait for pullbacks, in my view. You got to wait for pullbacks. You certainly should buy corrections, in my view. I don't know how many times I have to prove that to you. And I'm also, you know, looking at pullbacks in bonds, looking to add more. Right now, about 10% of my portfolio is allocated towards bonds, and I'm looking to add more. I took some profit on TMF, which is up 38%. This is the leveraged version of TLT, basically. So the leveraged ETFs I don't want to hold. I took some profit on that, and I'm just going to be holding TLT, and then we'll likely play a big position on the pullback in futures, in bond futures. And then I do have another monster gold setup that I'm looking at as well. And I do have another ticker symbol, just like Unity, just like we smashed Unity for almost 500%. We bought it down here in the 20s. I do have another ticker symbol that might be on the verge of a breakout like this. So I will be sending that out in the Discord as well. Anyway, but I invite you to join the Discord for 5 days. Come and monitor it. See if what I say is true. I invite you to do that. Use the coupon code below. Join us if you actually want access to all of our trades. Just come and join us. There's another coupon code below if you are looking to join us. And I'm doing a free mastermind on January 7th. You have to have your name on this wait list. So make sure you get your name on this wait list and we will do the free mastermind. Anyway, traders, that is it for this video. Let me know if you got something out of it. Let me know down below. Did you invest? Are you sitting in cash? What do you think? Are we going to crash? Do you think that we're going to make all-time highs and continue rallying? Do you think we'll see a recession? Would love to know your thoughts. Hit that thumbs up if you got anything out of this video. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.